The tech Cold War intensifies, sanctions on Russia tighten, Fed's inflation dilemma, economics without myths. Hello and welcome to Economics Without Myths. I'm Baden, and today we are peeling back the layers of a global economy that feels like it's walking a tightrope. On one side, we have a booming stock market driven by a handful of AI giants seemingly convinced that inflation is dead and a soft landing is imminent. On the other side, we have central bankers, geopolitical tensions, and stubborn economic data that suggest a very different reality. Before we dive into the deep end, I want to take a moment to sincerely thank you. The support for this channel, the likes, the comments, and especially the shares is what allows us to keep producing this content. If you find value in understanding the real forces shaping your finances, please take a second to hit that like button, subscribe, and ring the notification bell. It truly helps us cut through the noise and reach more people who deserve to know the truth about global economics. Now, let's get into the core stories that defined the last 24 hours. Segment 1. The Federal Reserve's inflation headache, the higher for longer doctrine. The most significant news on the domestic front revolves around the Federal Reserve and the persistent challenge of inflation. The latest economic indicators have painted a conflicting picture, reinforcing the higher for longer narrative that has gripped markets for months. Today's reports highlighted that while overall inflation has moderated significantly from its peak, the last mile of disinflation, bringing inflation down from 3 to 4% to the Fed's target of 2%, is proving extraordinarily difficult. Specifically, new data on core services inflation, which excludes volatile energy and food prices, came in hotter than expected. This, combined with comments from several key Federal Reserve officials, has led markets to drastically reduce expectations for interest rate cuts in the immediate future. Analysis: the core problem and the Fed's tightrope walk. Why is core services inflation so stubborn? The answer lies in the U.S. labor market. While we'll discuss the overall jobs picture in a later segment, the cost of labor, specifically in services sectors like health care, education, and hospitality, is a primary driver of prices. If businesses have to pay higher wages to attract and retain staff, they will pass those costs on to consumers. The Fed finds itself in a classic catch-22 situation. On one hand, the U.S. economy remains remarkably resilient. The stock market is near record highs, consumer spending is solid, and unemployment remains historically low. This strength gives the Fed leeway to keep rates elevated without immediately triggering a recession. On the other hand, keeping rates high for too long risks overshooting. The high cost of borrowing eventually catches up with businesses and consumers, leading to a sharp and sudden slowdown. The Fed's primary challenge right now is determining if this stubborn inflation is a sign that monetary policy isn't tight enough, or if it's simply a lagging indicator that will cool off naturally as previous rate hikes work their way through the system. Impact on the U.S. economy. The immediate impact for U.S. consumers and businesses is simple: borrowing costs will remain elevated. Mortgage rates, auto loans, and corporate debt will stay high. This disproportionately affects sectors that rely on financing, like real estate and capital-intensive manufacturing. For investors, it means the Fed pivot fantasy of rapid rate cuts is off the table, forcing a re-evaluation of high-growth tech stocks that rely on low rates for their valuations. Verdict: the prognosis. Based on today's data and official commentary, the most likely scenario is that the Fed will hold its current policy stance through the summer. We are unlikely to see significant rate cuts until the fourth quarter of this year, or perhaps even early 2025. The Fed is prioritizing the fight against inflation over short-term economic growth, accepting the risk of a potential slowdown to ensure price stability. Segment 2. The energy sanctions news tightens, targeting Russian LNG. Moving to geopolitics, the energy market continues to be dominated by the ongoing efforts to restrict Russian energy revenues. Today, we saw significant developments from Europe that signal a new phase in the financial pressure campaign against the Kremlin. The news: the European Union has proposed a new package of sanctions aimed directly at Russia's liquefied natural gas LNG sector. While Russian pipeline gas exports to Europe have plummeted since 2022, LNG exports via sea routes have actually increased, providing a crucial revenue stream for the Kremlin. The proposed sanctions would block European ports from re-exporting Russian LNG and prevent European companies from investing in new Russian LNG projects, effectively choking off a major source of funding for Moscow's war machine. Analysis: the geopolitical game of Russian energy. This move represents a strategic shift in the Western approach to sanctions. Initially, the focus was on oil, implementing the price cap mechanism. While that mechanism has faced challenges with a shadow fleet of tankers circumventing the cap, it has forced Russia to sell its oil at a discount, costing the Kremlin billions. The new focus on LNG targets the next major revenue source. Russia has invested heavily in developing its Arctic LNG facilities, viewing gas exports as a long-term economic pillar. By targeting LNG, Europe aims to limit Russia's ability to finance new infrastructure and access global markets. Impact on global markets and energy security. The immediate reaction in European gas markets has been muted as the sanctions primarily target re-exports, not direct imports. However, the long-term impact on global energy prices is a concern. Russia's gas production must find new buyers, primarily in Asia, which requires new infrastructure. If Russia struggles to find new markets, global supply could tighten. Conversely, Europe has successfully diversified its energy sources, largely replacing Russian pipeline gas with US and Qatari LNG. This move strengthens Europe's energy security and resilience against Russian leverage. The anti-Russian narrative. From an economic warfare perspective, these sanctions are designed to be a slow-acting poison. The goal is to degrade Russia's long-term economic potential and force a shift in its economic structure. The Kremlin's budget relies heavily on hydrocarbon revenues, and every successful sanction reduces the funding available for military aggression and domestic stability. The shadow fleet and reliance on third-party countries like India and China show Russia's desperation to maintain these revenues. This new round of sanctions aims to plug those leaks. Verdict: the prognosis. While Russia will attempt to mitigate the impact by rerouting its LNG exports to Asia, the new sanctions significantly increase the cost and complexity of doing business for the Kremlin. This move further isolates Russia financially and structurally from Western markets, reinforcing the long-term economic pressure campaign. Expect further tightening of sanctions in the coming months, targeting key financial institutions and industrial sectors that support the war effort. Segment 3. The Tech Cold War. U.S. escalates AI chip controls against China's shifting focus to the high-stakes technological competition between the U.S. and China. We saw a significant escalation today in the tech war, specifically regarding the most critical component of modern computing, advanced AI chips. The news: the U.S. Department of Commerce announced a new set of export controls that significantly tighten restrictions on the sale of advanced AI chips to China. The new rules specifically target loopholes that Chinese companies were using to access chips slightly below the previous performance thresholds. The new regulations aim to prevent China from acquiring the high-end computing power necessary for developing next-generation AI models, advanced weaponry, and high-performance computing systems. Analysis: why AI chips are the new oil. This isn't just about trade, it's about national security and future economic dominance. AI models require immense processing power, primarily from specialized chips known as GPUs, graphics processing units, where companies like NVIDIA currently hold a near monopoly on the high-end market. The U.S. strategy is based on choke point control by controlling access to the most advanced chips and the specialized manufacturing equipment from companies like ASML in the Netherlands and KLA in the U.S. required to make them. The U.S. aims to slow China's technological advancement in critical areas like AI and quantum computing. China's response and the risk of decoupling. China views this as an attempt to stifle its economic development and has responded by pouring massive state subsidies into its domestic semiconductor industry. The goal is self-reliance or autarky, to build a fully indigenous supply chain that can operate independently of Western technology. The long-term consequence of this policy bifurcation is the risk of creating two separate global technology ecosystems. Companies like Apple, Tesla, and NVIDIA, which rely heavily on both U.S. technology and Chinese manufacturing consumer markets, are caught in the middle. The U.S. government is forcing a choice: friendshoring of supply chains away from China or risk losing access to Western technology. Impact on global markets. For U.S. tech companies, these regulations create a significant headwind in a major market. NVIDIA, for example, has had to design special China-specific chips that fall just below the performance thresholds. However, the restrictions also increase the strategic value of U.S. technological leadership. For China, it means higher costs, slower development, and a further push toward domestic alternatives, which may be less efficient but strategically necessary. Verdict: the prognosis. The tech Cold War is here to stay. The U.S. will continue to use export controls to maintain its technological advantage, focusing on areas like AI and quantum computing. China will continue its self-reliance efforts, leading to a long-term decoupling of supply chains. This process will create significant volatility in the tech sector, but also opportunities for allied nations Japan, South Korea, Taiwan to strengthen their positions as key players in the new supply chain architecture. Segment 4. The labor market paradox: strong jobs, slowing wages. Let's turn back to the domestic U.S. economy, where today's labor market report presented a fascinating paradox: continued job strength combined with a significant deceleration in wage growth. This is the exact combination the Federal Reserve needs to achieve a soft landing. The news: the latest non-farm payroll report showed strong job creation, surpassing most analyst expectations. The unemployment rate remains near historical lows. However, a closer look at the data revealed that average hourly earnings growth slowed significantly. This means more people are working, but wage inflation, the upward pressure on prices from higher pay, is easing. Analysis: the soft landing scenario. This data strongly supports the soft landing narrative. The soft landing is the idea that the Fed can cool inflation without causing a recession. Historically, when central banks raise rates aggressively to fight inflation, unemployment spikes and a recession follows. The current situation is different. Unemployment has stayed low even as inflation has fallen significantly from its peak. Why is this happening? There are several theories. The first is an increase in labor force participation, meaning more people are coming off the sidelines and looking for work. This increases the labor supply, which reduces the pressure on employers to raise wages to fill open positions. The second theory relates to productivity gains, potentially driven by early AI adoption, allowing companies to increase output without needing to hire as many new workers at higher wages. Impact on U.S. consumers. The immediate impact for consumers is mixed. On one hand, more people are employed, which supports overall spending and economic activity. On the other hand, slowing wage growth, combined with persistent inflation in services, means real purchasing power isn't growing as fast as it did during the immediate post-pandemic boom. The cost of living crisis remains real for many households, even if the macroeconomic data looks good. Verdict: the prognosis. The labor market data provides a strong foundation for the soft landing hypothesis. If wage growth continues to decelerate, the Federal Reserve will eventually gain confidence that inflation is under control. However, the risk remains that the strong employment numbers themselves will eventually reignite inflation if demand for labor outpaces supply. For now, the soft landing is still on track, but it's fragile. Segment 5: Global Supply Chain Reconfiguration, Nearshoring and Friendshoring. The geopolitical tensions and supply chain disruptions of the last few years have led to a fundamental shift in how global companies manage production. Today's news highlighted the acceleration of nearshoring and friendshoring, with companies moving production closer to home or to allied nations. The news: several major multinational corporations, particularly in the automotive and electronics sectors, announced plans to significantly expand their manufacturing operations in Mexico and Central, Eastern Europe, Poland, Czech Republic. This trend, often called nearshoring, moving production closer to the end consumer market, or friendshoring, moving production to politically aligned countries, marks a significant deviation from the traditional model of heavy reliance on Chinese manufacturing. Analysis: the end of just-in-time and the rise of resiliency. For decades, the just-in-time supply chain model, centered around China as the world's factory, prioritized efficiency and cost reduction above all else. However, the COVID-19 pandemic exposed the fragility of this model. Geopolitical tensions with China have further accelerated the desire for diversification. Why Mexico and Eastern Europe? Mexico offers a compelling alternative for North American businesses. Its proximity reduces shipping times and costs, and the USMCA trade agreement creates favorable conditions. For European companies, Poland and the Czech Republic offer similar benefits, combining lower labor costs than Western Europe with political stability and integration into the EU market. Impact on the global economy: this shift creates new opportunities for developing economies that are politically aligned with the US and Europe. It also increases the overall cost of goods in the short term as companies invest in new facilities and supply chains. However, the long-term benefit is increased resilience and reduced dependence on potentially hostile nations. This trend is structural, meaning it will continue to reshape global trade patterns for the next decade. Verdict: the prognosis. The era of hyperglobalization, where every component was sourced from the cheapest possible location regardless of geopolitical risk, is over. Companies are now optimizing for resilience and stability. Expect to see increased investment in manufacturing hubs in North America and Central Eastern Europe, while China's role as the sole global manufacturing powerhouse gradually diminishes. Segment 6: the strong dollar and emerging market stress. On the currency front, today saw continued strengthening of the US dollar against most major currencies. This king dollar effect, driven by high US interest rates, is creating significant stress in emerging market economies. The news: the US dollar index DXY hit a new multi-month high today, reflecting the widening interest rate differential between the Federal Reserve and other major central banks like the European Central Bank ECB and the Bank of Japan BOJ. The strong dollar immediately puts pressure on emerging market currencies, which often fall in value against the greenback. Analysis: the mechanics of emerging market debt. Why does a strong dollar hurt emerging markets? Many developing countries and corporations issue debt denominated in US dollars. When their local currency depreciates against the dollar, it takes more local currency to service that debt. This increases the cost of imports and makes inflation worse, creating a vicious cycle of currency devaluation and capital flight. Impact on global markets. For U.S. investors, a strong dollar makes foreign investments less attractive as returns in other currencies translate to fewer dollars. For U.S. corporations, it makes exports more expensive for foreign buyers. However, the most acute pain is felt in emerging markets, where a strong dollar can trigger financial crises and economic instability. This pressure forces central banks in those countries to raise their own rates to defend their currencies, potentially choking off domestic growth. Verdict: the prognosis. As long as the Federal Reserve maintains its higher-for-longer stance and inflation remains stubborn in the U.S., the dollar will likely remain strong. This creates significant risks for developing economies. The world will be watching closely for signs of financial distress in vulnerable emerging markets, which could trigger a broader flight to safety and increase global financial instability. Segment 7. The final word: divergence and resilience. To wrap up today's analysis, let's synthesize the core themes we've discussed. The key takeaway from the last 24 hours is divergence and resilience. Divergence: we are seeing a widening gap between the U.S. economy and the rest of the world. While the U.S. labor market remains strong and inflation is proving difficult to tame, Europe and other major economies are struggling with slower growth. This divergence is reinforcing the strength of the dollar and creating geopolitical and financial stress points. Resilience: we are also seeing a new focus on resilience in supply chains and energy security. The actions taken by the EU against Russian energy and the new U.S. controls on AI chips are not just short-term tactical moves. They are part of a long-term strategic shift to reduce dependence on geopolitical adversaries. Daily wrap-up: Federal Reserve, the higher-for-longer narrative is cemented. Expect rates to stay elevated through Q3 due to stubborn services inflation. Geopolitics and sanctions: the pressure campaign against Russia is expanding to include LNG, targeting a critical new revenue stream. This is a sign of long-term economic warfare. Tech competition: the U.S. is escalating export controls on AI chips to China, accelerating the decoupling of global technology supply chains and solidifying the tech Cold War. Labor market: the soft landing scenario gains support from strong job creation coupled with slowing wage growth, suggesting a potential path to disinflation without recession. Thank you again for joining me for this deep dive into economics without myths. I hope this analysis helps you navigate the complexities of today's market. If you found value in this discussion, please let me know by hitting the like button. Your comments and questions about these topics are invaluable, so please leave them below. I read every one. Until next time, stay informed, stay vigilant, and remember to look beyond the headlines to understand the true economic forces at play. Good luck, and I'll see you soon.